everybody, I hope we're all doing well and having a great weekend. I was actually going to make this video because somebody requested me to make something on this topic anyways, but I thought I may as well turn it into one of these exclusive videos for the VIP chat. So I guess really the title that we can coin this as is understanding order blocks. So, the first way is how to identify them. Then also understanding the validation of those zones. So understanding how we can confirm that that zone has definitely been left unmitigated and hasn't been mitigated prior. But then understanding the likelihood that that zone will hold. So this is going to be quite difficult just because of the fact that it's a very confusing concept to grasp, and I'm going to do my best to explain it in a way that is understandable, but hopefully, it sinks in and you can sort of grasp what I'm saying. So the first thing that we need to understand, and there's two main things we need to understand before we really get into this, and the first one is the fractal nature of the market. So that's just understanding that we see this as clear bearish structure. We'll put that in red. But we understand that within that structure, for price to go from A to B, it's not just going to have a straight drop and then a straight move back up. We actually have structure within structure. So we have bearish structure within that, which comes to trade us down to where we want to go. Okay? So something along those lines, however it may look. I don't think I really need to draw the whole of this out, but, we're pretty much just understanding the picture here, aren't we? Where in order for us to get from A to B, we have an entire trend within that. And then we could go into that even further. So we might actually just have to zoom in slightly here. And this goes on pretty much an infinite number of times. So we have the same thing again inside of here. Now, just so that we have something to reference, let's say that red equals 1 day TF. Okay, the red line is representing the 1 day time frame. So let's put that in red. We'll then go and just say, I don't know, blue represents the 2 hour time frame. And we'll put that in blue so it's easier to reference. And then finally, the green may represent, I don't know, the 5 minute, let's say. So green equal 5 min TF. Now we're working within these 3 different time frames. Now, if we were to look on the 1 day on any structure, if it was bearish, it would look something like that, where we have candle down, candle back up, candle down, candle back up, so on and so forth. But then we understand that within that 1 day candle, if we were to go to a lower time frame, we'd reveal a lot more information. So, that 1 day candle, 24 hours, then becomes 12 candles as we go to the 2 hour, because of course we have 12 2 hours in 24 hours. So what was a single candle down is now 12 candles. And those 12 candles are no longer just going to be 12 consecutive bearish candles, are they? What's going to happen is, at least with wicks or even bullish candles in between, we may have, bearish, bullish, so on and so forth. But what's happening, even though we have a mixture of both bearish, bullish candles, we have different bits of structure within this, we still understand the fact that price has still gone from A to B. It's just that we're revealing more information of how price got from A to B. And when it comes to the green time frame, same again, how many 5 minutes are in 2 hours? I believe that's going to be 12 again. So, we then reveal 12 times more information once again. So that's the first thing we need to understand. And we'll leave that there for the time being. Second thing that we need to understand is that why do we have regions in the market that are left unmitigated? Like, what is an order block? So firstly, we have to understand Wyckoff price cycles, and that's understanding that, within moves in the market, however we may see those. Okay. What we have is a downtrend into an accumulation, an uptrend into a distribution, a downtrend into an accumulation. Now, what will happen is we'll still have structure within that, whereas we have a low here, the low that's been created over here, let's just imagine there's accumulation there, has been created higher. and now price will trade up, surpass that high. So we're still breaking the highs, protecting the low, so it would still be bullish structure within that, but we're understanding that within that, we're always going to have a mark up, a Wyckoff schematic, a mark down, a Wyckoff schematic. So what that means is that in structure or regular structure, I want this to be red, when we see something like this, what's happened here is that in this move up, in order for this correctional wave to be formed, at the accumulation down here, the larger interest, the institutions, the central banks, the composite man, whatever you know them as, I'm just going to say the institutions throughout this video, but they're all the same thing, has opened a position down here, which has caused that correctional wave to be able to be created. Which means that right here, at this level, there is a buy position that remains open. And of course, price is trading all the way down here, which means that if they have a buy position open there, that buy position is running in a massive loss. That can't continue to happen. We can't continue to see price trading down for years to come or for a long time to come and that order still be there in a minus. So what's going to happen is price is eventually going to trade back up to or will surpass that line, in which case that buy position can be mitigated. And once that buy position is mitigated, that means the buy position is taken off. Now what we have to understand is because of the size of the positions that the institutions execute on the market, we understand that those positions hold a lot of supply or a lot of demand. So a buy position is going to hold demand, a sell position is going to hold supply. So in this case, we have a large buy position here. That buy position is contributing to the supply and demand balance. Now let's imagine that as of right now, we're bearish. So that means that the overall supply and demand balance in the market, I don't know, just random figures, is 7,000 to 4,000 in supply's favor. This position may hold, I don't know, 300 demand, just using random figures. So the second we take that position off, we have removed 300 from demand, which means that now the supply and demand balance is tilted slightly more heavily into supply's favor. So what's going to happen is the simple removal of that position is going to introduce supply. And then on top of that, as we distribute inside of that order block, we're introducing more supply. So not only have we removed demand, we're also creating another Wyckoff schematic to introduce more supply. So that is why the mitigation of an order block, or in this case, a supply zone, and the reason why it's called a supply zone is because when we tap into that zone, we tilt the market more heavily into supply's favor. Now, what you will notice in a market is that, okay, every time we identify a supply zone, as long as it's valid, it doesn't hold every single time, which is fine. It doesn't have to hold every single time. All that it is doing, and what it does do every single time, is introduce supply. It's just a case of whether that supply that's been introduced is enough to cause a reversal that is big enough to then come and surpass the previous level. If, however, we introduce supply, we come down to here, it's not quite enough supply, okay, we then might make a move higher. But you'll notice pretty much every single valid zone that I identify, even if it doesn't hold and cause a major reversal, it's still, or we still see price have a small reaction to that zone before then invalidating it, which is why I'm so big on partials, because when that scenario does occur and does happen, and price only has that small reaction, we can still bank some profit from the fact that the mitigation of that order has introduced supply, and we can get or take advantage of that. But if it wasn't enough to cause a major move, it means that we're covered, we still walk away with profits, and we prepare for any scenario. So, I mean, that's taken a while just to explain those two topics. And this is where we're going to delve a little bit deeper into what's going on here. So, if we were just on the 1 day time frame, okay, we would view this region and we would say that, okay, so what's happened is on the 1 day time frame, we have a buy position that's been opened there. And this correctional wave comes back up to mitigate it. So this 1 day unrefined zone has been mitigated. But this is where it gets confusing, because what can happen here is that technically this has been mitigated, but if we now look at the blue structure, for example, we can see that this buy to sell here has not been mitigated. So if we have that as a supply zone, this zone right here remains unmitigated because no price action has come back up to it. In the same way that this one remains unmitigated because no price action has come back up to it. But as we see with this one, it taps back in. Okay, so we tap that line. Okay, we've come back in. And what we want to do is we want to go through all the impulses and corrections to see if the correctional wave comes back up to tap the previous low in the market. Now, the reason why this gets confusing is because its integration within fractal structure can have varying effects. So, as I said, on one time frame, this region is technically mitigated. And we can see that prices come back up, tapped into this overall position, and then continued lower. Now, what I say in terms of this, and in terms of how can we truly identify these zones, it's a case of what's happening is we have an option as to whether or not we want to refine those zones. Because what's happened here is that if we were to refine the zone using the 2-hour time frame, that is a zone we would be looking for because it is the highest supply zone in this region that is valid. If we were to simply use the 1-day time frame, we would be taking this overall zone. But when it comes to refining regions, we understand that there's many positions inside of here that could be left unmitigated. So, for example, we have this as well. And for argument's sake, let's just say price tapped into that. Right, so I just want to insert this clip here just to give a little bit of context as to what I'm saying about the refinement process. So obviously we can be looking at that 1-day red structure and look at that overall buy to sell and where prices come back in and tapped into that overall buy to sell of the red structure, the 1-day structure where we've had that correctional wave, where I've just taken that overall box. And then I'm also saying that, well, we also have that refined 2-hour zone just towards the top of the overall zone. Now, the point that I'm getting at and the reason why I'm saying it's confusing is because when we tap the overall zone, we are still taking a buy position off because the start of that red correctional wave holds a buy position in the same way of that the start of the blue correctional wave where we've identified the smaller zone also holds a buy position. So both regions count because both regions hold a buy position from the institutions that is still active. What we have to understand is it's likely the higher time frame we're viewing on when we see a buy to sell or a correctional wave, the higher time frame we are on, likely the larger that position may be. And therefore, it's a case of sometimes price may only tap the unrefined zone, the higher time frame zone, before reversing, because in that case, when it has removed that buy position from that time frame structure, that has been enough demand removed to cause a reversal. On the flip side, if that happens and the institutions decide there's still more room for more demand to be taken out, they need more supply to cause a longer term reversal, they may then decide to trade even higher to mitigate even more zones to therefore help tilting the supply and demand balance in their favour. So the bottom line is it all comes back to the supply and demand balance, making sure it's in their favour for the move and doing what they can to ensure that supply and demand balance is in their favour. But then on top of that, we have many of these zones. So the thing is we have two options. Now I'm going to take this overall non-refined zone and change it to orange just so it sticks out. Now there's pros and cons to both. When we take the unrefined zone, it is much more likely that that zone gets tapped. But when it does get tapped, we can't get as refined of an entry, because imagine that we want to sell now. We always really want our stop loss above that zone. So now, when we look at the RR reward of this trade, we're only looking at like a 1.8. Obviously, we may be able to refine that stop loss, but technically, price could actually move anywhere within this zone before reversing. So technically, we would want our stop loss above. So the likelihood of it getting tapped is higher, However, the refinement of our entry is much less. Now, as it comes to these, what we're seeing is as we're refining those positions and refining those zones, we have 3 here. Now, what could happen is that, okay, we've opened a position here. As price tapped into that one, we would have been able to get a more refined entry, as you see here, at 3.6 to 1, but we would have taken a loss there. But then price trades into this one, and eventually we take a win. So we've had a -1 RR, but we've managed to gain 5 RR back, so that's 4 total. So that's still more than the original position. But what we're understanding is when it comes to refining supply zones or refining demand zones, the con of that is the case of we're likely going to have multiple zones identified, which means that we may have to take 2 losses before price eventually trades us up into this. You know, for example, we could have seen this happen, price invalidate the second one, sorry, and then eventually come up to reverse in that zone there. Now, what we have to understand is as we refine these zones more and more and more, it becomes less likely for the zone to hold, but we can refine that position more. So I hope that is making sense there. And that's sort of like the overall point that I want to try and make within valid order blocks, blah, 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 because each one of these is valid. You know, this overall orange box is valid in the same way that these 3 zones are valid, because in order to validate them, we understand that a buy position has been opened here in scheme of the blue structure. And what's happened is that prices come in, tapped into it, mitigated that. Now, the reason this is valid is because no structure prior to the tap here ever came back up into it, which means it remained unmitigated as price moved away. Same with that zone, same with that zone. You know, same again with, I believe that zone, let's just pretend that one hits, but, you know, same again with this zone. You know, there's going to be many, many different zones within here that could be correct because of the fact that price is not traded back up. In the same way in this daily structure, that this one is correct because no structure, in terms of the daily structure, had traded us back up prior until now. So that is something we need to understand with zones. The other thing we need to understand is that the more fractalized we go with structure, the smaller the position is, or the smaller that buy position is within this. So let me try and make that make sense. If we were just viewing daily structure and we were taking this as our order and therefore this as our zone, we would understand that for price to have such a big correction wave, so from A to B there, that is a large distance, and therefore the buy position that's been opened here is relatively very large. If we compare that now to the buy position that has been opened here, that's only had to cause a move from A to B here, so a much smaller distance. Therefore, the buy position that has been opened here, again, is much, much smaller relatively than the one that has been opened here. Now, the point I'm getting at is that typically when we see a mitigation on the 1 day or the higher time frames, those mitigations hold more reversal power because of the fact that we are taking off a larger position and therefore in this example taking out more demand and flipping the supply and demand balance more heavily into supply's favor. Let's say instead what happened is that price actually reversed in this zone. We're actually introducing less supply into the market from the reaction of this because we have not mitigated these 2 orders, okay? So these 2 smaller orders are yet to be mitigated, and so is this. So what's happened is we've not removed as much demand from the market with this correctional wave. On the flip side, if price does deliver us a nice deep pullback like it has in this example, where it has mitigated everything in that region, it has removed all possible demand in the market that it can. So what happens is, and something I've talked about in the past, is that when we see deep pullbacks, it can be a sign that that trend is in jeopardy because the institutions require to remove more demand from the market in order to cause that next move down. Okay, if they are able to just come up, mitigate this small zone and go lower, leaving all this demand in the market that is present from all the orders up here, that means that there is that much supply in the market that they simply don't need to remove those positions because they have enough supply anyway to cause that move lower. So this is also why we can use the length of correctional waves as an indication of the strength of that trend. Obviously, the larger the correctional wave is, the more demand it's had to remove from the market, which is a sign that there is less supply, as we've had to remove more demand to put that balance in the favor that we want it to be. If it's a smaller correctional wave, it means that we've had to remove significantly less demand from the market, which means that relatively supply is much, much more dominant in this scenario where prices reacted here. So scenario A, there is much more supply present than there is in scenario B. Now, I hope that makes sense. And I hope that you're sort of getting the gist of what I'm saying here. I've sort of crammed quite a few concepts into this, but I hope this does make sense. Because I see a lot of people in the market are, getting confused with this, and it's quite hard to fully understand order blocks, how they're valid, so on and so forth. But I hope that little diagram has made sense. What we can now do is head on over to the live markets and try to see this live. So what we can do here is we can just follow the structure. Now, looking inside of here, we have to understand, okay, well, where's the last buy to sells? And let me just have a very quick look through so I know exactly how to talk about and teach this. So straight away, we can see taking a last buy to sell in this region already been mitigated. So that is not mitigated, right? Taking the last buy to sell in this region, which I would straight away want to take this buy to sell. But what we have to understand is that if you see these wicks just after the zone, they come extremely close. And I would argue we have a pullback up into there, which means that this zone is not valid. Now, most of you, if you were just told to look for a buy to sell candle, you would quite simply just identify that and say that's valid, wait for price to push in, but then it never does because you have not validated that zone. We can understand that that wick represents the fact that price has already come back and tapped into that. So both of these zones we've identified so far are invalid, and we can represent that. Okay, and then we'll keep working upwards to see if it's the same again. Here we have a buy to sell, which price pretty much comes back up to. So I'd say that again, already mitigated. We have a buy to sell in this region. And I know it doesn't look like a perfect buy to sell candle, but if we use the wicks, we understand that from the bottom of this wick to the top of this one here, we've had a buy and then a heavy sell-off. Okay, so if we just highlight those wicks alone, again, we understand structure has already come back up to it. Therefore, it is already mitigated. Zone invalidation. Okay, again, we have a wick here, which would come up to the top there. Okay, well, that hard to tell exactly where that wick comes, but we could argue, okay, this one's valid because no structure returns fully into to mitigate that. And if we really scroll in, it appears we are correct, where price hasn't actually fully tapped in. So we could say, yes, that one is valid. Okay, we move up again, following those wicks. We see we've started from here, up. So that's a buy up and then a heavy sell afterwards. Okay, so we would identify that as a supply zone. Oh, wait, price has already tapped back in. That is no longer valid. So that is another invalid zone. Where else do we have one? Okay, here we seem to have, following these wicks, a buy to sell in this region. So from the bottom of that wick up represents a buy and then a heavy sell afterwards. We don't actually see any price action return to that. So technically, we could argue this one is still valid. Again, here we have a buy to sell. Price already taps that. It's invalid. Okay, and I'm assuming you're sort of understanding the gist of what I'm getting at here. I'm using the wicks to understand where we've had a last buy to sell. And then I'm looking to see if price has already tapped into it. And, I don't think there's anything else in there. There is potentially another region here where we see a buy to sell. And each time I'm identifying these, there's some criteria alongside it where yes, I'm looking for a buy to sell, but I also want to pair that buy to sell, if we're looking for supply zones, with market inefficiency afterward the fact. So what we see is we see a buy to sell, and then this candle represents the fact that we've had a heavy push down after this buy to sell, which represents the fact that this buy to sell has had the purpose of creating a high volume push down, which is good confirmation that the institutions are present or are behind that move. So we have worked upwards, we have identified all of these regions. We have identified the fact that some of them are valid, some of them are invalid. Now let's go down to the daily time frame. And this is something else we can do. And we can further refine or validate these zones. So looking inside of here, we can see, yes, that buy to sell was definitely mitigated. We were also correct in this, but where we just identified a small region, you see that this overall buy to sell, we were right in saying this is valid because no structure returns. In each of the ones we have identified prior and said that they were invalid, yet that one's also invalid. So we tap into there, but then we could argue that this wick up to here is another zone, but again, already been tapped, invalid. So even when we use the higher time frames, following the wicks, we could quite perfectly identify the zones which were valid and the zones which were not. And even as we go down to lower time frames, we can try and do the same. You know, we could work backwards. We're not going to do it because that will take a long time, but we could even work backwards. We have a small buy to sell there, already mitigated. We have a small buy to sell there, already mitigated. We have a buy to sell here, not mitigated. So we could do the same, go back through, and it all depends how much you want to refine those zones, but that is the process that I would go through in order to validate my zones that I am identifying. It all depends on the time frame we are on. So if I wanted to trade this most recent impulse lower and I wanted to try and identify some supply zones, that's where we could start looking at regions in here of buy to sell. So I understand from here up to here is a buy to sell region, inefficiency after the fact, no structure comes back in, not even wicks after here trade back into it. Okay, we look inside of here, that is a last buy to sell, but we see that price falls through and then these wicks re-enter that region. So that is no longer valid. We see in here another zone where we have a buy to sell, but that wick comes back up. So this region in here also unmitigated because we have high volume push through, no structure to return. Keep following this buy to sell, already been mitigated. This buy to sell, this wick returns back in, so that's been mitigated. But then here we have a buy to sell region, again unmitigated. So these are three valid zones we have identified, doing that process again. And one thing I also want to point out is that it's not always just looking at the candle, the last buy to sell candle, it's understanding where did the actual buying begin. So for example, down here, we could just take this as the zone, but we understand that at the bottom of the wick here, that's where the real buying started in that push up. Same again here, the real buying started, or the real buying started. So the reason why it's confusing is because there's many ways to view it, many different approaches we can take when it comes to identifying the zones. But if you try and copy what I've done there, and I was just following it through, looking for regions where we've had a buy up there, you know, we've had a buy to sell here, we've paired it with inefficiency each time. So with each of these zones I've identified, we see straight below the zone or straight after the creation of the zone, we have a high volume bearish candle. So we're pairing that zone with inefficiency, because if there's inefficiency below, we understand it's very unlikely that price has returned to that region. So I'm just going to insert this clip here because I was trying to get at something at this point in the video which didn't really make sense when I was explaining it, but I want to try and give the example. So if you remember with the red and blue structure we're saying here, following the red structure, let's just get the brush. This is what the red structure would be telling us about this. Now, what's happened is that technically in terms of the red structure, and sorry, I haven't actually leveled that up correctly. Let's just redo that. So I hit the exact swing points. Apologies about that. So we start from here, come all the way right back down, all the way down here, all the way back up. We can now see that in this example, technically on the 1 day time frame, we have mitigated this position because of the fact that we see that this structure returns to this line. However, if we were to then look at the blue structure, for example, and we'll change the color of this in a second, let's just change out the blue. We can see that in terms of the blue structure, not all positions have been mitigated because of the fact that looking inside of here, we have this buy to sell. Sorry, actually that one is mitigated, so that one would be invalid. But up here where we have this buy to sell, this has been left unmitigated. So had we not used a range of time frames and we were just looking at the red structure, we would assume that everything inside of there has already been mitigated. However, now that we've gone lower, we can identify the fact that we actually have a buy to sell here that remains unmitigated. Now, the reason why this could throw some people off is because in the future, price may decide to start invalidating structure to the upside, in which case people are saying, right, we're going bullish for a long, long time to come now. But what's actually happening is this bullishness has the purpose of coming back up to mitigate this position before distributing and making a move lower. At this point, a lot of people are scratching their heads like, well, why on earth has price just randomly traded us up into this region? We have absolutely no idea why it's done so. There's no way that needs mitigating because we're looking at red structure. Technically, we've already mitigated this correction wave. But as we've gone down a time frame, we can look inside of here and say, well, that actually makes sense because on this time frame, we can see that there is a clear buy to sell paired with market inefficiency afterwards that represents an unmitigated order that prices wanted to come back up to and mitigate before making a move lower. So just understand that, and that's the implications of how we can use a range of time frames to our advantage when it comes to understanding order mitigation and what zones in the market are valid. So make sure that we are using a range of time frames within our top down and looking into the zones we identify on a range of time frames to identify the validity, to identify whether we like them. You know, just for an example, we could look inside of here on an even lower time frame into this buy to sell region. If we just head on over to that to try and confirm the validity, or even to try and refine that. So we see that yes, price is still valid because we see that even on this time frame, we have a high volume push through, no structure returns into it. But what we may now decide to do, and imagine now that we're looking at the green structure, where we have price coming up, and we then have structure moving forward, what the green structure allows us to do is refine that point of interest, where we see now that the actual last buy to sell candle is this right there. This is valid because we have inefficiencies before the fact. And if we actually use the wicks, we understand with the wicks, as we were doing before, the buy starts from here and ends at that wick. So we could actually refine the zone, which was that distance. We've shortened that zone by at least a half. And if we now zoom back out, just wait for price to catch up. And if we bring this across, we understand that we could have found an entry here now with a stop loss half the size, because where we would have got involved here earlier with the stop loss above, we can now get involved here with the stop loss above. So the reason why, as I'm going to say again after this clip ends, it's really confusing is because we're working within many different time frames, we're working within many different concepts, but just put this into practice, keep working it out in your analysis, and eventually you're going to find your own routine that makes sense, and eventually the whole concept in itself will make sense to you. So I'll leave you back to the rest of this video, which is basically me apologizing for the fact of how confusing everything is, but I hope you enjoy. But yeah, I'm sort of waffling now. I think that has covered everything it can. As I stated at the start, I know this is confusing and I'm struggling to really try and explain this because I'm trying to cram everything into one video, whereas like this whole concept would take like consecutive videos one after the other to slowly go through. I've tried to sort of cram it in as much as possible into this video, but I hope everything I've gone over here, and I know this is very long, so make sure you've taken notes. I hope that has helped you understand, firstly, what zones are, understanding how we can refine them, understanding how we can validate them, understanding why zones hold reversal power through the fact that we have orders that are getting taken out. But then secondly, as I went through here, how we can look through the markets in order to identify and validate those zones correctly. So I hope this has helped. Apologies for any part of it that is confusing, because the topic in itself is very confusing. So if you do have any questions, make sure to let me know. Make sure to leave a comment down below, and I'll get back to you and try and answer that to the best of my abilities. If there's any small concepts or topics within this overall video that you would like me to delve deeper within, to try and shed some more light on, again, let me know. But I hope you've all enjoyed this for the exclusive video this week. And yeah, we'll see you next week for another exclusive video. If you have any ideas on that, make sure to let me know.